Oppenheimer is increasing its price target on Nvidia from $110 to $150 in response to the chipmaker's stock split, which is good news for the company. A number of factors, according to the analyst conducting the call, are helping Nvidia achieve sustained outsized top-line growth. Brad, this is just one of many price targets that analysts have raised. Argus Research and Goldman Sachs analysts have also raised their respective price targets. According to Argus, Nvidia's stock could continue to rise in 2025 following a robust year of growth in 2024. As they move outside the data center and explore prospects in other aspects of the business, all of these analysts are seeing a lot more space to run in this stock, which has been on such a tear, up almost 150% year to date. Goldman Sachs and Evercore ISI released their notes ahead of schedule both last week and at the beginning of this week. With all of these things taken into account, ordinary investors may view Nvidia as being much more affordable, especially in light of Goldman Sachs' recent discussion of it as the de facto AI play. More broadly, though, it's becoming more about where they can see some of that demand for chips going forward, particularly with the rest of the market shifting toward applications. In other words, models sit on top of applications, which in turn sit on top of the chips. Just consider the inferential technology these companies were talking about at Computex 2 weeks ago. If you already have the chips, and they will only get bigger. While it's true that we currently have 60,000 chip data centers, everyone was pointing out that Nvidia stands to gain far more from the possibility of those centers expanding to 1 million chips. Because of this, analysts are joining us on the show to talk about how absurd it is that this $3 trillion market cap could only be the beginning, especially in light of the recent 10-for-1 stock split. I'm curious as to whether there's more room for us to run or if we've reached our limit. Analysts and other guests have frequently told us that there is, in fact, more opportunity for expansion, particularly in the gaming and automotive industries, two segments of the firm with significant growth potential. In terms of the whole stack of AI hardware, networking, and software solutions, Oppenheimer is providing Nvidia with the best placement and stature. We will continue to track shares of NVDA throughout the week. You were in Nvidia before it was hip. You were purchasing it at $4 back in 2014, riding the wave from this stock to $330 back in 2021. However, the current rally you missed because your flagship ARK Innovation ETF sold out of your main stake back in January. Why? Well, if you're really optimistic on Nvidia, we have been very positive on Nvidia. We bought it down when it hit roughly $100 in the fourth quarter last year, and then it tripled when some of our other AI-oriented stocks remained still. Believe it or not, many people do not believe this about us, but we are looking at relative valuations of names in the AI field. We compared Nvidia at 25 times sales, which is where it is, to Tesla, which is perhaps the largest AI story out there, at 6 times earnings. UiPath reported yesterday, and as a great AI play, it too is at 6 times sales. As for Nvidia, there are a few reasons we take some pause. It still satisfies our minimum hurdle rate of return of 15% at a compound annual rate over 5 years, so you will see it in some of our more specialized portfolios. We are searching for better values, but the dangers to Nvidia include cyclical worries. Upon hearing about shortages, be they of GPUs or anything else, my mind automatically turns to a group's cyclical nature. The level of competition is increasing. Google, Meta Platforms, and Tesla are all developing their own processors for larger, more specialized language models. We're learning from Meta Platforms that the LLM model is able to execute with less computer power but more data, yielding superior models. Thus, as always, a number of forces are at work. How many disgruntled investors have contacted you about your purchases or the ETFs on Twitter or through other channels? The fact that you retained it in several funds but not the primary ARK ETF must have caused you a great deal of frustration. The main thing that has happened is that from 2014 to 2021, those who were aware of the Nvidia narrative were constant. As you pointed out, Palantir, UiPath, and Tesla are just a few of the many names you have that are focused on artificial intelligence. Do you genuinely think there will be a few prominent names that you favor, or am I missing something? No, Another name for it would be Twilio. With the possible exception of a small number of highly specialized businesses, such as multinational corporations like Exact Sciences, almost every business uses its extensive distribution networks and internal proprietary data to gather information and develop better goods and services. Therefore, I would argue that practically every business in our portfolio is using artificial intelligence as a powerful tool in one way or another. 90% of the names in the portfolio, in my estimation, are using it and do have private data. My attention was drawn to the notable disruption in market capitalization that companies affected by ChatGPT have already experienced. I consider Coursera, the educational startup, but you mentioned that ChatGPT platforms might disintermediate Apple's app platform, for instance. Is it a crucial corporation whose disruption we should be concerned about? Which other brands spring to mind that the market might be undervaluing in terms of how much this new rival could overwhelm them? Either ChatGPT was the worst thing that ever happened to Google, or it might have been the best. We frequently assume that ChatGPT and other chatbots would disintermediate it, so we might not require the kind of search, and thus, advertising, that is the foundation of Google's business model. That one does concern us, then. As you mentioned, many people think that Amazon itself may be disrupted, not just by social commerce, where customers shop on Instagram and other social media platforms, like Pinterest, but also by consumers using ChatGPT and other AI tools to find exactly what they want, directly from the source, and at the lowest price possible worldwide. Every platform that has acted as a middleman is vulnerable. We believe that nvidia has remained stable in the face of a sell-off in the market as a whole. This hour, CEO Jensen Huang will be speaking, and Seema Modi has some news for us. Seema, what's going on? Jensen Huang, the CEO of Nvidia, is arguing in favor of accelerated computing and highlighting the critical role Nvidia plays in enabling quicker model execution inside data centers. He's also defending the cost of the servers that the business sells. Although Nvidia servers are costly, at over $2 million per rack, thousands of nodes are replaced by them. It is astounding to learn that the cost of replacing the connections alone between outdated general-purpose computer systems would have exceeded the cost of replacing every single system by consolidating them into a single rack. These remarks were given during the Communicopia conference hosted by Goldman Sachs. David Solomon, the CEO of Goldman Sachs and the moderator of this discussion, raised an important point regarding the AI's return on investment. Huang claimed that employing Nvidia's GPUs is generating cost savings and increased productivity for businesses. Businesses are cutting computation times by a factor of 20. He said that since demand is still so high, every dollar spent with us now buys roughly $5 worth of rentals, meaning we are still in the initial wave of demand. Furthermore, he claimed that the corporation will gain from the fact that inference, the process of training, and then using AI models, actually uses less energy. Although shares are currently higher, David, they are still below the day's highs. Please let me know if you require any further changes.